September has been a fairly rough month on interest rates so far. Let's discuss the big headlines this past week and the financial markets for the week ahead. Oil gushing higher. I'm sure you've noticed, as I have, the price at the pump is marching higher. The price of oil hit 10-month highs due to lower supply levels and production cuts from Saudi Arabia and Russia. This rise has also led to a spike in both jet fuel and diesel. The latter is a concern because we learned last summer how higher diesel prices elevated food inflation, as it is everywhere in the food supply chain. Diesel is used in mills, factories, and shipping, so if diesel goes higher, food costs are going to go higher. Bonds loathe inflation, so any news showing that it may be on the rise is bad for rates, and bad news it was. The 10-year note yield rose to 4.3% after touching 4.05% on September 1st. This news may very well confirm that inflation bottomed out in June at 3% and is creeping higher. The Cleveland Fed is now expecting inflation to rise closer to 4% in September, and their forecast does not include this recent shock in oil, which will undoubtedly put more pressure on inflation to rise. There are two ways to lower oil prices. One, global demand slows, thereby creating more supply. And two, the U.S. creates more supply. Yet, seeing that the U.S. is not ramping up energy production, we have to hope that demand slows in order to lower prices. Yet, with Russia and Saudi Arabia just extending their oil production cuts for another 3 months, any demand slowdown could be offset by less supply, hence elevated prices and more inflationary pressure. The U.S. dollar is getting stronger. The dollar has been strengthening over the past couple of weeks as the U.S. once again outperforms virtually all other global economies. Europe appears like it's heading into a recession in the second half of this year. China and other countries throughout Asia are also struggling. This leads strength in the dollar. Typically, a strong dollar would help oil prices to some degree, but the production cuts and the already lower supply are keeping oil prices elevated. A strong dollar has also created another problem. The yen in Japan and the yuan in China have weakened sharply against the dollar, making imports more expensive. Both countries have spoken out about the need to keep their currency strong. And how would they do this? Well, the two countries combined own close to $2 trillion worth of U.S. treasuries. What they have been doing as of late, and what they could threaten to do, is sell treasuries to purchase their own currency to prop it up against our strengthening dollar. Should this come to pass, this extra supply could put further upward pressure on rates. Fed rate hike chances. As of this moment, the chance of a Fed rate hike in September is very small, but the chance of a rate hike in November is about 50%, or a coin toss. Should oil prices rise further, it would put pressure on the Fed to raise rates once again. I wish I had a brighter outlook to share in today's update. However, this all may be setting us up for a challenging fall season in interest rates. Bottom line, in the absence of a surprise shock to the markets, any relief in rates in the near term will be minimal and fleeting, much like we've seen over the past several months. Watch 4% on the 10-year Treasury note as a pivot point. If the 10-year note yield moves beneath 4%, we will likely see sustained rate relief, with the opposite being true. Now, looking ahead, this coming week, we will see the last of 5 reports the Federal Reserve is watching prior to the September Fed meeting. That would be August's Consumer Price Index, or CPI, report to be released on Wednesday. As noted, inflation is likely to be higher than in July, and there is fear of an upside surprise because of oil. All right, let's go ahead and take a look at the charts. On the right side of the chart, you can see clearly how prices have rebounded higher from the exact price lows or rate peaks of October. If prices remain above these bottoms, we will see some stabilization in rates, but if prices fall beneath this floor, we will see home loan rates rise to perhaps the highest level this century. All right, guys, thanks for hanging out with me for a few minutes this week. I hope this has been valuable for you. Feel free to share, like, comment, and have yourself a great week.